Money doesn't care about borders. It goes where it's treated best. That single truth explains more about the global economy than any political speech ever will. Capital chases after-tax returns, legal certainty, and low friction. It runs the same calculation in every currency, every country, every year. When a nation gets these conditions right, wealth floods in. When it doesn't, money vanishes. Sometimes before anyone notices it leaving. The countries left behind are outcompeted, by design. So how do nations actually build systems that win? We're starting from first principles, what capital really seeks, and why most countries never deliver it. What if the single most valuable asset isn't land, factories, or patents, but the ability to move money freely? Capital seeks one thing, the highest after-tax, risk-adjusted return. Every tax rate chips away at that number. Every transaction cost, every legal uncertainty, the calculation runs identically whether you're in Tokyo, Toronto, or Timbuktu. But here's what separates rich countries from poor ones. Capital moves faster than governments can react. It relocates while politicians are still drafting press releases. And once it's gone, convincing it to return costs far more than keeping it ever did. This speed turns small differences into enormous ones. A few extra percentage points of tax, a few additional weeks of waiting for permits. These gaps that look minor on paper redirect billions across borders. The proof shows up in the numbers. In 1980, average corporate tax rates across developed countries sat around 40%. Today, they hover near 23%. Countries discovered that shaving a few points off the tax drew mobile capital, so they kept cutting. Then their neighbors cut. Then everyone cut. The race hasn't stopped since. But taxes only start the calculation. Leverage finishes it. When investors borrow cheaply against appreciating assets, returns multiply. A jurisdiction that lowers barriers doesn't just pull in capital, it pulls in leveraged capital, chasing amplified gains. The rewards for becoming competitive compound year after year. This explains why the competition never ends. Every country cutting taxes or streamlining rules forces neighbors to match or watch money walk out the door. Capital doesn't need to negotiate. It can do what it wants. It simply leaves. So if money follows these metrics so precisely, the next question becomes obvious. Where exactly do profits appear on the books? And who decides? The answer lives inside tax codes that most people never read, but the wealthy know by heart. A German factory makes car parts. An Irish office shuffles paperwork. Guess which one books the profit? When a multinational operates across borders, it faces one question: where should earnings officially appear? The tools to decide are entirely legal and devastatingly effective. Transfer pricing comes first. A company selling products between its own subsidiaries sets the internal price. That German factory sells components to an Irish distribution hub. Germany taxes profits at 30%. Ireland charges 12.5%. Price the components high enough, and German margins collapse to nearly nothing, while Irish profits swell. Same products, same company, half the tax bill. Intellectual property works even better. Patents, trademarks, and software licenses are notoriously hard to value, which makes them easy to relocate on paper. A pharmaceutical company transfers a drug patent to a subsidiary in Dublin. Now, every sale worldwide generates royalty payments flowing straight to that low-tax entity. The research happened in Boston, manufacturing happens in Munich, but because it's more tax efficient, the profits appear in a small Irish office with a handful of employees. Treaty shopping adds another layer. Countries sign agreements reducing taxes on cross-border payments. Companies route funds through whichever jurisdictions offer the best deals, shaving the bill at every step. In 2021, over 130 countries agreed to a 15% global minimum corporate tax, an attempt to slow the game. But structures are already adapting to this. The rules change, the optimization continues. Germany funds the research, Ireland books the profit, The money doesn't disappear, it just shows up on someone else's ledger. This is the tax code functioning exactly as written. But taxes are only one variable capital calculates. Speed matters too. You could have two different countries with identical tax rates. One attracts billions, the other watches capital flee. The difference might have nothing to do with taxes and everything to do with waiting. Every permit application sitting on a bureaucrat's desk costs money. Every approval that requires a meeting that schedules another meeting. Every customs hold, licensing delay, and form that needs a stamp from an office that closes at noon. In some countries, launching a company takes a single afternoon and an online form. In others, it takes 6 months and a stack of paperwork no one can fully explain. Investors know how much delays and bureaucracy like this can cost, so they take their money somewhere easier. Capital controls make things worse. These restrictions limit how much currency you can exchange, trap profits inside borders, and might even require government approval before money leaves the country. When investors suspect they can't get out later, they stop calculating returns. They start planning escape routes. But slow systems aren't even the real problem. Unpredictable ones are. Retroactive taxes announced after you've already invested. Export bans on industries that were legal last month. Rules written one way, applied another, depending on who you know. Investors watching these moves learn one lesson: expect chaos. And when investors expect chaos, they demand compensation. Higher returns to offset the risk. That premium gets priced into every deal, a surcharge for uncertainty that compounds over time. Stability works the opposite way. When rules stay consistent, risk premiums shrink. Investment arrives steadily instead of fleeing at the first rumor of trouble. Singapore built an empire on this principle. Company registration takes hours. Timelines are published and followed. Enforcement stays consistent regardless of who's applying. A tiny city-state with zero natural resources now holds one of the highest concentrations of wealth per capita on Earth. That's what happens when a country decides to compete. Taxes and speed covered, one question remains: who protects the assets once they arrive? That answer separates temporary parking spots from permanent vaults. Now, let's talk about asset protection and legal predictability. When it comes to money, the wealthy protect assets first and wave flags second. They don't ask which country they love. They ask which legal system will defend their wealth against lawsuits, divorces, political seizures, and governments that change their minds. The answer determines where their money ends up. Legal tools make this possible. Trusts separate a person from their assets, wealth managed for their benefit, but held by an entity creditors struggle to reach. Banking secrecy shields holdings from foreign courts. Clear bankruptcy laws tell everyone in advance who gets paid first, making lenders more willing to extend credit. Property rights that survive elections matter more than property rights that don't. Switzerland figured this out before anyone else. After World War II, while the rest of Europe rebuilt from rubble, Swiss bankers offered something more valuable than high returns: certainty. Their courts enforced contracts, regardless of political convenience. Judges delivered consistent rulings decade after decade. This obviously attracted large amounts of capital from all over the world. Meanwhile, governments elsewhere lurched between policies and parties, nationalizing industries one year, privatizing them the next. Wealthy families across the continent noticed. They learned to trust Zurich and Geneva with holdings they wouldn't risk keeping in other countries. This consistency pays dividends, literally. When lenders believe contracts will be enforced, they charge lower rates. When insurers trust that property rights remain stable, they cut premiums. The entire cost of doing business drops when the rules don't change every election cycle. Trusts, nominee structures, and cross-border agreements let wealth survive any single government, any single crisis, any single lifetime. Local political risk gets converted into manageable legal process. Most people deal with whatever legal system they're born into. They can't choose which courts hear their disputes. But the wealthy operate differently. They shop for jurisdictions the way consumers compare phone plans, hunting for the best combination of protection, cost, and reliability. Now stack low taxes, speed, and legal safety together. What do you get? The offshore system. Offshore is a machine, engineered, optimized, and operating in plain sight. The machine runs on 3 layers, each selling something different. Secrecy jurisdictions sell invisibility. Companies register without publicly listing who actually owns them. Local directors sign paperwork on behalf of real owners whose names never appear in any filing. Whether the money behind these structures was earned legally or was stolen, the paperwork looks identical. Conduit jurisdictions sell access. The Netherlands, Luxembourg, Mauritius, they've built extensive treaty networks with major economies, positioning themselves as middlemen in global finance. Money passes through not because any real business happens there, but because the routing slashes taxes at the final destination. These countries have turned geography into a product. Then service providers connect the pieces. Law firms draft the structures, accounting firms optimize the flows, banks open the accounts. Each piece is legal on its own. Combined, they create pathways that move wealth anywhere while minimizing taxes and maximizing privacy. The system's durability comes from one uncomfortable fact. Legitimate tax planning and illicit money movement use identical structures. The same corporate layers that help a multinational reduce its tax bill can obscure the origins of corrupt payments or stolen funds. Nobody can tell the difference from the outside. Researchers tracking outflows from developing countries estimate hundreds of billions leave each year through mispriced trade invoices alone. Goods deliberately valued incorrectly so the difference stays offshore. The UAE advertises itself explicitly as a destination for global wealth. Zero personal income tax, easy company formation, straightforward rules for moving money in and out. High net worth individuals flood in by the thousands every year, no questions asked. This infrastructure exists whether any individual country likes it or not. Every nation now competes against a machine, purpose-built to attract mobile capital. But what happens to the countries that lose this competition? The damage is quieter than you'd expect, and far worse. Losing capital isn't some abstract concept. It looks like empty factories, unpaid teachers, and hospitals that never get built. When money leaves a country, wealthy individuals moving savings abroad, companies booking profits elsewhere, foreign investors pulling out, the damage ripples through everything. Most citizens never trace the effects back to the source. They just feel poorer and don't know why. Borrowing costs rise first. Less capital available domestically means banks charge more for loans. Governments pay higher interest on debt. Businesses pay more to expand. Homebuyers pay more for mortgages. The departure of mobile wealth becomes a tax on everyone who couldn't leave. The tax base shrinks next. With corporate profits reported elsewhere and wealthy individuals paying taxes in other jurisdictions, governments face the gap. They can raise rates on workers and small businesses who can't relocate. They can cut services, or they can borrow more at higher rates, compounding the problem. Every option makes next year harder. Then the spiral accelerates. Higher taxes push more capital out. More outflows mean higher borrowing costs. Higher costs mean less investment. Less investment means fewer jobs. Fewer jobs mean less tax revenue. The people who suffer most are those with no ability to escape. Economists studying sub-Saharan Africa found that over several decades, capital outflows reached roughly $700 billion. Much of the money borrowed by these governments, loans citizens are still repaying through taxes today, went directly into private offshore accounts. The public inherited the debt. Private individuals kept the assets. And brain drain compounds the damage further. When capital leaves, opportunity leaves with it. Doctors, engineers, and entrepreneurs follow the money to places where their skills command higher returns. The countries that need talent most watch it walk out the door. There's no explosion, no dramatic headline when capital leaves. A country simply wakes up poorer, pays more for everything, and watches its best people leave. The damage is systemic, and the rules made it inevitable. No conspiracy runs this system. No shadowy group pulls the strings. This is design, pure and simple. Rules, incentives, and institutional choices create the geography of wealth. Some countries have built systems to attract capital. Others have built systems that repel it. The money responds exactly as the math predicts. But the tools to change this exist. Global minimum taxes that limit the race to the bottom, transparency rules revealing the real people behind shell companies, courts that enforce contracts reliably enough to compete. None of it is impossible. But every country choosing reform competes against countries that won't, and against infrastructures already engineered to move money elsewhere. So the question becomes, do we accept systems that pick winners by design, or do we demand different rules? Drop your answer in the comments. Hit the like button, subscribe. We have lots more videos coming for you.